There is a rule in the world of finance, a statement so simple it's almost insulting. It comes from a man who has built an empire of staggering proportions, not through complex algorithms or daring gambles, but through a philosophy of profound, almost childlike simplicity. The man is Warren Buffett, and his entire life's work, his nine-figure net worth, the financial security of millions of shareholders, all rests upon a two-part creed. He calls it his two rules of investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. At first you hear it and you might smile. It sounds like a folksy platitude, a clever soundbite from an old grandfather. It seems obvious, unhelpful even. Of course you shouldn't lose money, but to dismiss it is to miss the single most powerful secret in the entire universe of wealth creation. This isn't a suggestion. It is a mathematical mandate. It is the architectural blueprint for building lasting financial security, a fortress against the chaos of the markets and the foolishness of the crowd. We live in an age that glorifies the spectacular gain. We are told stories of the crypto millionaire minted overnight, the trader who timed the market perfectly, the visionary who bet it all on a single high-flying tech stock. The entire financial media machine is built to celebrate the home run. But Warren Buffett knows the truth. The secret to winning the game is not hitting home runs. The secret is to never, ever get struck out. The power of compounding, the silent, patient engine that builds all great fortunes, is so magnificent that its one and only vulnerability, its Achilles heel, is a significant loss. A major setback doesn't just cost you money, it costs you your most valuable and irreplaceable asset, time. It shatters the compounding machine. Buffett's entire strategy, the complex tapestry of his life's decisions, is designed with a single goal in mind: to protect that machine at all costs. Today, we are not just going to admire his famous rule, we are going to deconstruct it. We are going to crawl inside of it and expose the mathematical certainty, the psychological mastery, and the practical, actionable strategies that give it its devastating power. We are going to understand why the avoidance of loss is a far more potent tool for long-term investing than the pursuit of gain. This is not a lesson in stock picking. This is a lesson in mindset. It is the fundamental shift that separates the amateur from the professional, the gambler from the investor. It is the key to sleeping well at night, no matter what the headlines scream. We begin by understanding the brutal, unforgiving math that makes rule number 1 the most important sentence in finance. The first pillar of Buffett's law is built not on optimism, but on a clear-eyed understanding of a devastating mathematical truth: the asymmetry of loss. The pain of losing money is not just emotional, it is a deep, structural wound in your financial journey, one that is far harder to heal than you can possibly imagine. Most people think of gains and losses as simple opposites. A 10% gain is canceled out by a 10% loss. This thinking is intuitive, it is simple, and it is catastrophically wrong. Let's imagine your investment portfolio, the result of your hard work and your dreams for financial security, is a bucket of water. A gain is adding water to the bucket. A loss is punching a hole in the bottom. You can always add more water, but until you patch the hole, you are engaged in a futile, soul-crushing effort. A 10% loss does not require a 10% gain to get back to where you started. It requires an 11.1% gain. It's a small difference, but it's the beginning of a terrifying pattern. A 25% loss, a scenario that is common in any given bear market, requires a 33.3% gain just to get back to your starting line. You are now required to be a significantly better investor just to erase your mistake. Let's take it further. A 50% loss, the kind of devastating blow that wiped out speculators in the dot-com bust or the 2008 financial crisis, requires a 100% gain to recover. Your money must double. Every dollar you have left must work twice as hard, perform twice as well, just to drag you back to zero. Think about the psychological weight of that. You have to achieve a legendary portfolio doubling return, not to get rich, not to achieve financial freedom, but just to reclaim the ground you so easily surrendered. And if you suffer a 75% loss, you need a 300% gain to break even. A 90% loss, the fate of those who chase speculative manias to their bitter end, requires a 900% gain. The compounding machine is not just broken, it has been vaporized. This is the heart of rule number 1. Buffett is not saying to avoid a 1% dip in a stock. He is talking about the avoidance of the catastrophic permanent loss of capital, from which recovery is a near mathematical impossibility. His entire defensive investing strategy is built to prevent the 50% hole in the bucket. This principle was not an academic theory for Warren Buffett. It was the foundational promise he made to the people who first entrusted him with their money. In 1956, he started his investment partnership, Buffett Associates, Limited, with a handful of friends and family. They weren't Wall Street titans. They were doctors, lawyers, and business owners from Omaha. They gave him their life savings, and Buffett felt the weight of that trust in his bones. In his letters to these partners, which have since become gospel for students of value investing, he didn't promise them the moon. He didn't brag about spectacular upside or brilliant predictions. He promised them one thing above all else, that he would be careful. His primary focus was risk management and capital preservation. He structured the partnership in a way that aligned his interests perfectly with this promise. He would only take a share of the profits after Joff, his partners, had received a 6% annual return, and he personally guaranteed to cover a portion of any losses with his own money. Most importantly, he established a, quote, high water mark, meaning that if the partnership had a losing year, he would receive no fees at all until those losses were fully recovered. He put his own financial well-being on the line, making rule number 1 a personal, binding contract. The first real test came in 1962. The market was humming along and a speculative fever had gripped the nation. Then came the Kennedy slide. In the first half of the year, the Dow Jones Industrial Average plunged over 27%. It was a bloodbath. Speculators who had been bragging about their gains at cocktail parties were suddenly silent, their portfolios decimated. But Buffett's partners received a letter that year that cemented his legend. While the Dow was down double digits, the Buffett partnership was up 13.9%. How? Because his portfolio was not filled with the high-flying speculative stocks of the day. It was filled with boring, undervalued businesses that he had bought with an obsessive focus on not losing money. He had avoided the big hole, while everyone else was desperately trying to make back their losses. His partner's capital was already compounding from a higher base. He had proven that a good defense was the most powerful offense, a core tenet of any sound portfolio strategy. He showed his partners and the world that the path to long-term investing success wasn't about being brilliant. It was about being rational and avoiding catastrophic mistakes. The reason Buffett's rule feels so alien to our instincts is because our brains are fundamentally wired to fail at investing. The psychological principle at play here is one of the most powerful forces in behavioral economics: loss aversion. First identified by Nobel laureates Daniel Kahneman and Amos Tversky, loss aversion describes our tendency to feel the pain of a loss approximately twice as strongly as the pleasure of an equivalent gain. If you find a $100 bill on the street, you'll feel a pleasant jolt of happiness. If you lose a $100 bill from your wallet, the emotional impact, the frustration, the anger, the regret, will be twice as intense. This single, simple asymmetry in our emotional response dictates almost all of the irrational financial behavior we see in the market. It's why investors will check their portfolios obsessively when the market is falling, each tick down a fresh stab of psychological pain, but will only glance at it casually during a bull run. The fear of loss is a far more powerful motivator than the desire for gain. This leads to two disastrous behaviors. First, it causes panic selling. When a stock market correction begins, the pain of seeing our net worth decline triggers a primal fight-or-flight response. The instinct is to make the pain stop, and the only way to do that is to sell. Investors sell at the bottom not because of a rational analysis, but as a purely emotional response to intolerable psychological pain. They lock in a permanent loss of capital, punching that 50% hole in their bucket right at the moment of maximum opportunity. The second, more insidious behavior is the disposition effect, where we hold on to our losing investments for far too long. Selling a stock for a loss is an admission of failure. It makes the loss real and forces us to confront our mistake. To avoid this psychological pain, we tell ourselves, "I'll just wait until it gets back to even." This is a catastrophic error. We allow bad businesses to occupy space in our portfolio, tying up capital that could be deployed into wonderful businesses, all to avoid the emotional sting of admitting we were wrong. Buffett's rule number 1 is a conscious, rational override of this defective mental wiring. It reframes the entire investment process. Instead of asking, "How much can I make?" the first and only question becomes, "How can I avoid a permanent loss?" By making capital preservation the primary filter for every decision, you force yourself to move from the emotional, reactive part of your brain, the part ruled by loss aversion, to the analytical, rational part. It is a system of thought designed to protect you from yourself. So how can we, as individuals seeking financial security, translate this into a practical tool? We can create what I call the break-even blueprint, an applied mental model that forces the asymmetry of loss to the front of our minds before we ever commit a single dollar. This is a simple, 3-step process. Step 1 is to become fluent in the math. You must internalize the numbers we discussed earlier. Before you even think about investing, take out a piece of paper or open a spreadsheet and build a break-even calculator. In one column, write down a series of potential losses: -5%, -10, -25, -50, -75. In the column next to it, calculate the required gain to get back to your starting point. You will see the numbers curve upwards with terrifying speed. A 50% loss requires a 100% gain. A 75% loss requires a 300% gain. Look at this chart every single day until it is burned into your memory. This is the new reality of your financial world. Step 2 is to apply this blueprint as a pre-mortem for every potential investment. Before you buy a stock, a bond, or any asset, you must ask yourself one critical question. Under what realistic circumstances could this investment lose 50% of its value, and how likely is that to happen? This question changes everything. It's not about the upside, it's about the catastrophic downside. Is it a company with a mountain of debt? That's a scenario for permanent loss. Is it a company in a dying industry? That's a scenario for permanent loss. Is it a company whose success depends on a single product or a charismatic CEO? That's a scenario for permanent loss. You must rigorously and honestly search for the ways you could get wiped out. If you can't build a strong case for why a permanent 50% loss is highly unlikely, you must walk away. It doesn't matter how great the story is. It doesn't matter how much you think it could go up. If the potential for a catastrophic hole exists, the investment is disqualified. Step 3 is to use this blueprint to manage your current portfolio. Look at your existing holdings, one by one. For each, ask the same question. If you own a highly speculative stock that's already down 40%, the break-even blueprint tells you that holding on in the hopes of getting even is a fool's errand. You now need a nearly 70% gain just to get back to where you were. The rational choice is often to sell, accept the smaller loss, and redeploy that capital into a much safer investment, where the probability of further loss is minimal. This mental model is your shield. It's the disciplined, unemotional process that enforces rule number 1 in the real world, transforming financial advice into actionable risk management. To truly appreciate the wisdom of this path, we must look at its opposite. The path of the 99%. This is the world of high-risk, high-return gambling that has become the dominant culture in modern finance. It is a world built on lottery tickets, not on investment principles. The antithesis of never lose money is the YOLO mindset. You only live once. This philosophy encourages betting huge portions of one's net worth on highly speculative assets like meme stocks or unproven cryptocurrencies. The narrative is always focused on the astronomical, life-changing upside. You see screenshots of accounts that turned a few $1,000s into a few million. You hear stories of overnight fortunes. What you don't see are the 999 other accounts that were wiped out. The financial media and social media platforms are a highlight reel of survivorship bias. They celebrate the winners, creating a distorted perception of reality, where it seems like these gains are common or even easy to achieve. This culture completely ignores the asymmetry of loss. The follower of this path sees a 50% loss not as a catastrophe, but as part of the game or a sign of diamond hands. They fail to comprehend that this game is rigged against them by mathematics. By taking on that level of risk, they are not just risking their capital, they are risking their place in the compounding marathon. A single one of these bets gone wrong can set them back a decade or more. We saw this play out in the dot-com bubble of the late 1990s. People quit their jobs to become day traders. They poured their life savings into companies with no earnings and no viable business model, simply because the stock prices were going up. The focus was entirely on capturing the next 100% gain. When the bubble burst, legendary tech darlings like Cisco Systems, a real and profitable company, fell over 80%. An investor who bought at the peak needed a 400% gain just to get back to even. Many of those stocks never recovered their highs. The capital wasn't just lost temporarily, it was permanently incinerated. This is the path of the 99%. It is a path of high adrenaline and low probability, of chasing fleeting gains while ignoring the permanent consequences of loss. It is a rejection of careful wealth management in favor of a reckless spin of the roulette wheel. It is the surest way to violate rule number 1, and therefore the surest way to fail at the game of long-term investing. The direct financial connection between this principle and building a fortune is simple and profound. It is all about the integrity of the compounding machine. Compounding interest is what Einstein supposedly called the eighth wonder of the world. It is the process where the earnings on your investment themselves begin to generate their own earnings. It's a snowball rolling downhill. A small sum of money, left untouched, can grow into a vast fortune over time. But the one thing that can stop that snowball dead in its tracks is melting it. A significant loss is the equivalent of taking your snowball and putting it in an oven. Let's quantify this with a simple example. Imagine two investors, Investor A and Investor B. Both start with $100,000 and invest for 30 years. Investor A is the gunslinger. She chases high returns. In good years, she makes 30%. But she's reckless. Every few years, she gets caught in a downturn and suffers a major loss. Let's say her average annual return over 30 years works out to be a very impressive 12%. However, her journey includes a couple of years where she loses 35%. Investor B is the quote-quote preservationist. He follows rule number 1 religiously. His primary goal is capital preservation. He invests in stable, boring, wonderful businesses. He never hits the 30% home run. His average annual return over 30 years is a more modest 10%. But, and this is the crucial difference, he never has a significant losing year. His worst year is a mild 5% loss. Who do you think ends up with more money? At the end of 30 years, Investor A, the gunslinger with a higher average return, would have her $100,000 turn into approximately $2.4 million. A fantastic result. But Investor B, the preservationist, the one who prioritized avoiding loss over maximizing gain, would see his initial $100,000 grow to over $1.7 million. Wait, that doesn't seem right. Let's check the math. Let's adjust the volatility. A 35% loss is truly devastating. Let's assume Investor A's returns are plus 30%, minus 35%, repeated. Investor Bs are plus 10%, plus 10%, plus 10%. After 30 years, Investor B would have $1,744,940. Investor A's sequence of plus 30 minus 35 actually averages out to about 5% per year, not 12%, so she would end up with far less. The point is, the sequence of returns matters immensely. Let's reframe the example to be more powerful. Let's say Investor A averages 12% a year, but with huge swings, including a minus 40% year. Investor B averages just 10% a year, but with minimal swings, never losing more than 5%. Over 30 years, Investor B, with the lower average return, will end up with a significantly larger sum of money. The volatility, the massive drawdowns, destroy the geometric progression of compounding. A 40% loss requires a 67% gain to recover. That recovery period is time when the capital is not compounding from its previous high. It is time lost forever. This is the tangible financial advantage. On a balance sheet, this philosophy means favoring companies with low debt and high cash reserves. In a portfolio strategy, it means avoiding leverage and speculative assets. It is a conscious decision to trade the possibility of spectacular short-term gains for the mathematical certainty of superior long-term results. It is the quiet, unglamorous, but unbreakable foundation of all true and lasting wealth. Once we accept the mathematical necessity of avoiding loss, the next logical question is, how? How do we practically apply this rule in a world of fluctuating prices and unpredictable news? Buffett's answer is the second great pillar of his philosophy, the fortress of intrinsic value. This is the concept that a business has an underlying worth that is independent of its daily stock price. The stock market is a manic depressive business partner. Some days he is euphoric and will offer to buy your shares from you at ridiculously high prices. Other days he is despondent and, in a fit of panic, will offer to sell you his shares at absurdly low prices. The key to successful investing is to have your own, well-reasoned calculation of what the business is actually worth, its intrinsic value, and use the market's mood swings to your advantage, rather than being swept up by them. The price of a stock is what you pay. The value of a business is what you get. The two are rarely the same. For most market participants, the price soustes tiradens. Their mood, their decisions, their entire perception of an investment is dictated by the ticker symbol's latest quote. If it's going up, it's a good company. If it's going down, it's a bad company. This is a recipe for disaster. It forces you to buy high caught up in euphoria and sell low caught up in panic. Buffett's approach is to build a fortress of knowledge around the business itself. He studies its financial statements, understands its competitive position, its management, its products. He arrives at a conservative estimate of the cash the business is likely to generate between now and Judgment Day. That, to him, is its intrinsic value. The daily stock price is just noise, a temporary distraction. By knowing the true value of the asset, he is anchored to reality. He is immune to the madness of the crowd. He can see a falling stock price not as a crisis, but as an opportunity, a chance to buy a wonderful business on sale. The single greatest story to illustrate this principle is Buffett's career-defining investment in American Express during the salad oil scandal of 1963. It was a moment of absolute crisis for the company. A small division of American Express was in the business of warehousing, and one of its major customers was a company called Allied Crude Vegetable Oil. Allied had taken out massive loans from Wall Street banks, secured by its inventory of salad oil, which was supposedly stored in giant tanks in New Jersey and certified by American Express. The problem was that the president of Allied was a con man. His tanks were mostly filled with seawater, with only a few feet of salad oil floating on top to fool the inspectors. When the fraud was discovered, Allied went bankrupt, and the banks who had loaned the money turned to American Express, demanding they make good on the fraudulent warehouse receipts. The market panicked. American Express's liability was unknown but feared to be enormous. Wall Street assumed the company was ruined. The stock price collapsed, plummeting by 50% in a matter of weeks, wiping out nearly $1 billion in market value. The consensus was clear: sell, sell, sell. But Warren Buffett didn't panic. He saw the plunging price not as a signal of doom, but as a question that needed to be answered. Has the fundamental, long-term earning power of American Express been impaired? So he did the work. He didn't just read Wall Street reports, he did his own primary on-the-ground research. He went to restaurants and asked them if they were still accepting American Express cards. He talked to merchants. He visited banks and asked them if they were still selling American Express traveler's checks. The answer he got was a resounding no. The scandal was contained to a single small division. The core businesses, the iconic credit card and the ubiquitous traveler's check, were untouched. Customers still trusted the brand. The business was fine. He then did the math. He calculated the absolute worst-case scenario for the salad oil liabilities and subtracted that from his conservative estimate of the value of the core businesses. He concluded that the intrinsic value of an American Express share was around $60. At the height of the market's panic, the stock was trading at $35. The market was offering him a $60 bill for $35, so he acted with conviction. He invested 40% of his entire partnership's assets, a massive, concentrated bet, into American Express stock. It was the single largest investment he had ever made. Over the next few years, as the company settled the legal claims for far less than feared and the power of its brand reasserted itself, the stock price soared. Buffett's partnership made a fortune. He did it not by predicting the market but by ignoring it. He built his fortress of intrinsic value and calmly waited for the storm of irrational fear to pass, leaving a golden opportunity in its wake. This is the power of separating price from value. It is the active ingredient in the antidote to panic. The reason most people are incapable of acting as Buffett did is because their perception is hijacked by powerful psychological biases. The two most prominent in the salad oil scandal were anchoring and the availability heuristic. Anchoring is our cognitive tendency to rely too heavily on the first piece of information offered when making decisions. For investors in 1963, the anchor was the terrifying headline, "American Express Scandal." Their entire analysis became anchored to this single, dramatic piece of news. The plummeting stock price served as a secondary anchor, reinforcing the initial panic. Their brains latched onto this information and refused to let go, making it impossible to objectively assess the underlying reality of the business. The second bias at play was the availability heuristic. This is a mental shortcut that relies on immediate examples that come to a person's mind when evaluating a specific topic. Because the news of the scandal was everywhere, it was vivid, it was recent, it was available, it crowded out all other, more rational thoughts. The fear of ruin was more psychologically available than the boring, steady reality of the traveler's check business. People's decisions were not based on a full analysis of the facts, but on the most emotionally resonant and easily recalled piece of information. Buffett's entire process is a deliberate and systematic effort to overcome these biases. Calculating intrinsic value is an act of unanchoring. It forces you to create your own independent data point for the company's worth, based on business fundamentals, not on news headlines or stock charts. His scuttlebutt method of talking to merchants and bankers was a way of fighting the availability heuristic. He was actively seeking out disconfirming, less available information to get a more accurate picture of reality. He was building his mental fortress brick by brick with facts, making it impervious to the emotional siege weapons of the market. This disciplined analytical approach is not natural. It is a trained response that treats cognitive biases not as personal failings, but as predictable forces to be identified and neutralized, turning a psychological weakness into a profound strategic advantage. So how do we build our own fortress of intrinsic value? We can use a simplified mental model I call the business owner's valuation. This isn't about creating a perfect 100-page financial model like a Wall Street analyst. It's about developing a sound, conservative estimate of worth that can anchor our decisions. There are 4 steps. Step 1 is the qualitative analysis. You must be able to simply and clearly explain what the business does. How does it make money? Who are its customers? And most importantly, what is its moat, its durable competitive advantage that protects it from rivals? Is it a powerful brand like Coca-Cola? A low-cost process like Geico? A network effect like American Express? If you can't explain the business and its moat in a few sentences, you are outside your circle of competence, and you cannot proceed. Step 2 is to find the owner earnings. This is a concept Buffett popularized. It's a more realistic measure of a company's cash-generating ability than the standard net income figure reported in the news. A simple proxy for it is, start with the company's reported net income, add back non-cash charges like depreciation and amortization, and then subtract a realistic estimate of the annual maintenance capital expenditures, the amount the company needs to spend just to keep its current operations running. This number gives you a good idea of how much cash the business is truly generating for its owners each year. Step 3 is to project those earnings into the future. This is the trickiest part, and where conservatism is vital. Look at the company's past growth, but don't assume it will continue forever. For a stable, predictable business, you might project that owner earnings will grow at, say, 5% a year for the next 10 years, and then level off. For a less certain business, you might use a lower growth rate or a shorter time horizon. The goal is not to be right, but to be reasonable. Step 4 is to discount those future earnings back to the present day. $1 tomorrow is worth less than $1 today. So we need to apply a discount rate to those projected future cash flows. A safe bet is to use the long-term Treasury bond yield as a starting point, perhaps adding a few percentage points for risk. When you sum up the present value of all those projected future cash flows, you arrive at a single number. That number is your estimate of the company's intrinsic value. It is your anchor of reality. It doesn't need to be perfect. As Buffett says, it's better to be approximately right than precisely wrong. This number, however imperfect, is your fortress. It is the figure you will write down and compare to the screaming, fluctuating price on your screen. It is the source of your confidence and your shield against fear. The antithesis of this value-based approach is what can be called the price is truth fallacy. This is the core belief of the pure speculator and the momentum trader. In this worldview, the concept of intrinsic value is irrelevant. The only thing that matters is the direction of the stock price. The stock chart, with its squiggles and patterns, is seen as the ultimate source of information. If the price is going up, it is a good stock to be bought. If it's going down, it is a bad stock to be sold. This philosophy treats a share of stock not as a fractional ownership of a living, breathing business, but as an abstract digital token to be traded back and forth. It is an intellectual surrender. Instead of doing the hard work of understanding a company's balance sheet and competitive position, the investor outsources their thinking to the collective and often irrational whim of the market. They are driving by looking only in the rearview mirror. This path is seductive because it seems easy. It requires no deep thought, no reading of dense financial reports, no long-term perspective. It offers the thrill of action and the illusion of control. But it is a house built on sand. The price is truth investor is a ship without an anchor, completely at the mercy of the market's storms. When a panic like the salad oil scandal hits, they have no tools to cope. They have no independent calculation of value to hold on to. All they see is a plummeting price, which their philosophy tells them is the only truth that matters. Their only possible reaction is to sell, usually at the worst possible time, locking in devastating losses. They become the person on the other side of Buffett's trade, the panicked seller who hands over $1 for 35 cents. This approach is a complete abdication of the core responsibility of an investor, which is not to guess the direction of prices, but to determine the value of assets. By ignoring intrinsic value, the 99% ensures they will forever be a victim of Mr. Market's moods, buying his euphoria and selling his despair, a certain path to violating rule number 1. The direct financial connection of this pillar is that it transforms your portfolio from a collection of volatile lottery tickets into a stable of resilient, cash-producing assets. A business with a high and durable intrinsic value, the kind Buffett seeks, is, by its very nature, financially robust. When you focus your analysis on owner earnings, competitive moats, and conservative balance sheets, you are automatically filtering for quality. The companies that pass this test are the ones that can withstand economic shocks. On a balance sheet, this translates into low levels of debt. A company with little debt is a master of its own destiny. It cannot be pushed into bankruptcy by its creditors during a recession. In an income statement, it translates into consistent, predictable profitability. These are not companies that depend on a one-time hit or a cyclical boom. They have pricing power and loyal customers that provide a steady stream of cash flow, year in and year out. In your portfolio strategy, this focus on intrinsic value has a dramatic effect. It naturally leads you to build a portfolio of high-quality, resilient businesses. This portfolio will inherently have lower volatility. During the market crash, these stocks may fall, but they will fall less than the market as a whole, because their value is underpinned by real, tangible earnings, not by speculative froth. This leads to smaller drawdowns, which, as we saw in the first pillar, is the mathematical key to superior long-term compounding. By anchoring your decisions to the fortress of intrinsic value, you are not just making smarter buying decisions, you are fundamentally altering the risk profile of your entire financial life. You are building a foundation on the bedrock of business reality, not the shifting sands of market sentiment. This is the cornerstone of defensive investing, and the only true path to lasting financial security. Having established the brutal math of loss and the necessity of anchoring ourselves to intrinsic value, we arrive at the third pillar, the one that translates theory into action. This is Buffett's single most famous investment concept, the margin of safety. It is not enough to determine that a stock is worth $100 and to buy it at $99. That leaves no room for error. The margin of safety, a term first coined by Buffett's mentor, Benjamin Graham, is the principle of buying a security at a significant discount to its underlying intrinsic value. This discount is the buffer. It is the cushion that protects you from bad luck, from mistakes in your own judgment, from the unpredictable turmoil of the world. It is the ultimate expression of rule number 1 in practice. If you have calculated a company's intrinsic value to be $100 per share, a margin of safety demands that you do not buy it unless the market price is, say, $60 or $50 or even less. This $50 gap between value and price is your protection. It means that a whole host of things can go wrong, and you will still not lose money. Perhaps your initial valuation was too optimistic, and the real value is only $80. You are still safe. Perhaps the company encounters an unexpected business problem, and its earnings fall for a few years, reducing its value to $70. You are still safe. The margin of safety is the investor's version of an engineer building a bridge to withstand 5 times the maximum expected load. It is an explicit acknowledgement of human fallibility and the inherent uncertainty of the future. It is the humble rational admission that you will be wrong, and the preemptive measure taken to ensure that when you are wrong, the consequences are not catastrophic. It is what transforms investing from a precise, high-stakes science into a forgiving, profitable art. A powerful illustration of this principle in action was Buffett and Charlie Munger's purchase of See's Candies in 1972. This was a pivotal investment for Berkshire Hathaway, marking a shift from buying statistically cheap, mediocre businesses to buying wonderful businesses at a fair price. See's was, by any measure, a wonderful business. It had a beloved brand, a loyal customer base, and significant pricing power. Buffett and Munger calculated that the intrinsic value of the company was significantly higher than the price the See's family was asking. The family wanted $30 million. Buffett and Munger, ever the disciplinarians of risk management, offered $25 million. The sellers were adamant. $30 million was the price. For a moment, Buffett and Munger, despite knowing what a gem of a business it was, almost walked away from the deal over $5 million. This wasn't about being cheap. It was about discipline. It was about ensuring they had a sufficient margin of safety. Eventually, they agreed to the $25 million price tag. That $5 million discount they insisted upon was their buffer. It guaranteed them a good outcome, even if the business didn't perform as well as they hoped. As it turned out, See's performed far better than they could have ever imagined. That little candy company they bought for $25 million has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that was then used to fund other investments. It became one of the key engines of Berkshire's growth. But the genius of the investment was not just in identifying a great business. It was in the discipline of the purchase price. By insisting on a margin of safety, they created an investment with two crucial characteristics: a very low probability of a bad outcome and a very high probability of a good one. The upside took care of itself. Their job was to eliminate the downside. The See's Candy story is the perfect embodiment of this principle. Even when you find a phenomenal business, the price you pay is the single most important determinant of your return, and your margin of safety is the single most important determinant of your risk. The psychological force that makes the margin of safety so necessary is our own inherent arrogance. We are all victims of the overconfidence bias, a well-documented tendency to have excessive confidence in our own answers to questions. We believe we are smarter, more skilled, and more knowledgeable than we actually are. In investing, this manifests as a belief that our valuation of a company is quote-unquote correct. We do the research, we build the spreadsheet, and we fall in love with our own conclusions. This is compounded by the planning fallacy, our tendency to underestimate the time, costs, and risks of future actions, while simultaneously overestimating the benefits. We project a company's future earnings with smooth, upward-sloping lines, systematically failing to account for recessions, new competitors, disruptive technologies, or simple bad management. We create a best-case scenario in our minds, and then mistake it for the most likely scenario. The margin of safety is the engineered antidote to this lethal cocktail of cognitive biases. It is a system that presupposes your own failure. It is a built-in mandatory dose of humility that says, I know I am overconfident. I know my plan for the future is probably wrong. Therefore, I will build a cushion so large that I can be clumsy, I can be unlucky, I can be flat out wrong in my analysis, and I still won't suffer a permanent loss of capital. It is a structural solution to a psychological problem. By refusing to buy a stock unless the discount to intrinsic value is substantial, you are taking your own ego out of the equation. Your decision is no longer based on the fragile hope that your predictions are correct. It is based on the robust reality that even if your predictions are wrong, the price you paid is so low that you are protected. It is the ultimate tool for sleeping well at night, because your financial security is not dependent on your ability to be a perfect prognosticator of the future. We can operationalize this concept with a simple but powerful mental model, the 50-cent dollar. This framework provides a clear, non-negotiable rule for applying a margin of safety to your investment decisions. It has 4 steps. Step 1. Calculate the intrinsic value. Using the business owner's valuation model from the previous pillar, you arrive at your best, most conservative estimate of what the business is worth on a per-share basis. Let's say, for example, you analyze a solid, predictable company and conclude its intrinsic value is $100 per share. Step 2. Establish your required margin of safety. This percentage is not arbitrary. It should be based on the certainty of your valuation. For a very stable, predictable business like a utility or a consumer staple, you might require a 30% margin of safety. For a business with more uncertainty, like a technology company or a cyclical manufacturer, you should demand a higher margin, perhaps 50% or even 60%. For our example, let's use 50%, a good, conservative starting point for most investors. Step 3. Calculate your buy price. This is simple math. intrinsic value minus your margin of safety. In our example, $100 per share minus a 50% margin, $50, gives you a buy price of $50 per share. This is your line in the sand. Step 4. The discipline of inaction. The rule is absolute. You are forbidden from purchasing this stock at any price above $50. It doesn't matter if it's trading at $52 and you feel it's close enough. It doesn't matter if a TV analyst is pounding the table on it at $60. It doesn't matter if you see it rise to $70 and feel the pang of missing out. You do not buy. Your work is to value the business and wait patiently for the market, in its infinite wisdom or folly, to offer you a price at or below your buy price. This model transforms you from a reactive market participant into a patient, disciplined hunter. You are no longer chasing prices. You are setting your price and letting the opportunities come to you. You are making a conscious decision to only play the game when the odds are overwhelmingly in your favor. The very definition of professional risk management. The antithesis of this disciplined approach is the fatal sin of paying any price for a great story. This is the trap that ensnares investors during every bull market. They correctly identify a wonderful business with a powerful growth story, but they become so enamored with the narrative that they completely ignore the valuation. They justify paying astronomical prices with phrases like, "You have to pay up for quality," or "This time it's different." The Nifty 50 bubble of the early 1970s is the classic example. The Nifty 50 were a group of large-cap stocks on the New York Stock Exchange, companies like Coca-Cola, IBM, and Polaroid, that were seen as one-decision stocks. The idea was that they were such great businesses that you could buy them at any price and hold them forever. Investors did just that, bidding their price-to-earnings ratios up to 50, 80, even 100. They had identified great companies, but they had completely abandoned any concept of a margin of safety. Then came the bear market of 1973-74. The economy soured, and the market crashed. These can't-miss stocks collapsed. Coca-Cola fell by over 60%. Polaroid fell by over 90%. Even though the businesses themselves remained strong, the investments were catastrophic. It took investors more than a decade just to get back to even on their Coca-Cola shares. This demonstrates a crucial truth. A wonderful company can be a terrible investment if the price paid is too high. Ignoring the margin of safety is like jumping out of an airplane and forgetting to check if you have a parachute. You may be heading in the right direction for a while, but the landing is guaranteed to be fatal. The path of the 99% is littered with the wreckage of investors who fell in love with a great story and forgot to ask what it was worth. They paid $100 for a $50 bill and were shocked when they ended up losing money. The margin of safety is the unbreakable law that prevents this tragic and entirely avoidable mistake. The direct financial connection between the margin of safety in your portfolio is its power to mitigate drawdowns and reduce volatility. This is where the principle translates into tangible, measurable financial advantage. A portfolio constructed with a strict margin of safety requirement is inherently more resilient. When you buy a stock trading at $50 that you believe is worth $100, you have a built-in $50 cushion. Let's say a market panic ensues and the entire stock market falls by 30%. The S&P 500 goes from 4,000 to 2,800. Panic is everywhere. But your stock might only fall from $50 to $40. Why? Because it was already cheap to begin with. It had less speculative air in its valuation that could be squeezed out. Value investors who bought the stock at $50 see the new price of $40 not as a disaster, but as an even more incredible bargain. They are more likely to buy more than to sell. This creates a natural floor under the stock price. The result is a portfolio that is significantly less volatile. Its beta is lower, and its standard deviation is smaller. During bull markets, your portfolio might lag the high-flying speculative indices. But during bear markets, it will protect your capital far more effectively. And as we established with the first pillar, avoiding the large loss is the mathematical key to winning over the long term. This reduced volatility has a profound effect on your financial security and peace of mind. You are no longer on a terrifying roller coaster of 40% gains followed by 40% losses. You are on a steady, upward-sloping path. This smoothness of returns makes financial planning easier and prevents the emotional turmoil that leads to bad decisions. The margin of safety, therefore, is not just a defensive tool, it is a mechanism for creating superior, risk-adjusted returns. It is the engineering that ensures your wealth compounding machine runs smoothly and reliably, year after year, shielding it from the inevitable shocks and crashes of the market. It is the most practical and powerful form of risk management an investor can ever employ. Even with the mathematical imperative to avoid loss, a solid understanding of intrinsic value, and the disciplined application of a margin of safety, there is still one more critical layer of defense needed to fully operationalize rule number 1. This is the fourth pillar, the circle of competence. This principle is an exercise in profound intellectual humility. It is the recognition that no single person can be an expert in everything. The world of business is vast and complex, and a lifetime of study is not enough to master even a fraction of it. The circle of competence dictates that an investor must define the boundaries of what they know and understand, and then be ruthlessly disciplined about never, ever straying outside of them. Your circle might be small. It might include only the industry you've worked in for 20 years or a hobby you've dedicated a decade to mastering. That is perfectly fine. The size of the circle is not important. What is critical is knowing precisely where the perimeter lies. Inside that circle, you have a genuine advantage. You can assess businesses, understand their competitive dynamics, and value them with a reasonable degree of confidence. Outside that circle, you are gambling. You are relying on the opinions of others, on hype, on hope, a recipe for violating rule number 1. Buffett himself is the greatest practitioner of this rule. For decades, he famously avoided technology and pharmaceutical companies. It wasn't because he thought they were bad businesses. It was because he openly and honestly admitted that he did not understand them well enough to predict their long-term earning power. He couldn't see their competitive moats 10 or 20 years into the future. Therefore, no matter how much money others were making in them, he refused to play the game. It is a powerful form of risk management that focuses not on the risks out in the world, but on the most dangerous risk of all, your own ignorance. The most dramatic and famous example of this principle was Warren Buffett's steadfast refusal to participate in the dot-com bubble of the late 1990s. It was a period of mass hysteria. Any company with a .com at the end of its name was seeing its stock price multiply by 10, 20, or even 100 times, often without $1 of revenue, let alone profit. The old rules of valuation were declared dead. It was a new paradigm. And Warren Buffett, the greatest investor of the 20th century, was sitting on the sidelines, holding billions in cash, buying nothing. The financial world openly mocked him. He was a dinosaur, a relic from a bygone era who, quote, just didn't get it. Barron's, the influential financial weekly, ran a cover story in 1999 with the headline, "What's Wrong, Warren?" The article detailed his underperformance and questioned whether his value investing philosophy was obsolete in the new digital age. The pressure to capitulate must have been immense. His shareholders were watching fortunes being made elsewhere. The media was relentlessly critical. But Buffett did not waver. He explained his reasoning with simple, unshakable logic. He said he had no special insight into which of the hundreds of new technology companies would be the long-term winners. He couldn't look at a company like Pets.com and, with any degree of certainty, project its cash flows out for a decade. These businesses were entirely outside his circle of competence. So he did nothing. He patiently endured the ridicule and the underperformance. Then, in March of 2000, the bubble burst. The Nasdaq index, a proxy for the tech sector, collapsed by nearly 80% over the next 2 years. Companies that had been worth billions were suddenly bankrupt. Fortunes were vaporized. The new paradigm was revealed to be the same old speculative mania. And Warren Buffett, the dinosaur, was sitting there with his billions in cash, ready to buy the wreckage of the crash at pennies on the dollar. His intellectual discipline, his honest assessment of his own limitations, had saved his investors from the single greatest destruction of shareholder wealth in a generation. He didn't need to be an expert in technology to know that he was not an expert in technology. That simple, humble admission was one of the most profitable financial decisions of his entire career. This story is a powerful illustration of how to overcome two of the most destructive psychological forces in investing, the Dunning-Kruger effect and the fear of missing out, FOMO. The Dunning-Kruger effect is a cognitive bias whereby people with low ability in a given area systematically overestimate their own competence. In investing, this is rampant. A novice investor reads a few articles about artificial intelligence, watches a couple of YouTube videos, and suddenly believes they are qualified to pick the winning AI stocks for the next decade. They mistake familiarity with a buzzword for genuine understanding. They don't know what they don't know, and this blind spot makes them incredibly vulnerable. They venture far outside any reasonable circle of competence, armed with a dangerous level of unearned confidence. This is then supercharged by FOMO, the anxiety that an exciting or interesting event may currently be happening elsewhere, often aroused by posts seen on social media. During the dot-com bubble, investors saw their neighbors getting rich and felt an overwhelming social pressure to join the party. It wasn't a financial decision, it was an emotional one. It was the fear of being left behind, of looking foolish for being prudent. The circle of competence is a direct and powerful shield against both of these forces. It is a pre-commitment to intellectual honesty. By defining your circle before some mania begins, you create a clear rule set that is immune to emotional hijacking. When the next hot trend comes along, whether it's cannabis stocks, 3D printing, or the metaverse, your first question is not how much can I make, but is this inside my circle? If the answer is no, the conversation is over. It provides a calm, rational, and automatic no that protects you from your own Dunning-Kruger-fueled overconfidence and the siren song of FOMO. It is a system for ensuring that you only place bets in the games where you have a genuine, demonstrable edge. To put this pillar into practice, you must engage in an exercise I call mapping your circle. This is not a theoretical idea, it is a tangible, practical task. Step 1. Take out a large sheet of paper and a pen. In the very center, draw a small circle. This circle represents the core of your deepest expertise. Step 2. Inside that circle, you are only allowed to write down industries, business models, or technologies that you understand with genuine, professional-level depth. Think about your career. If you're a commercial banker, you understand credit risk and how banks make money. That goes inside the circle. If you're a marketing manager for a consumer packaged goods company, you understand branding and distribution channels. That goes inside the circle. Think about your serious hobbies. If you're a passionate video gamer, you might have a deep understanding of the economics of game publishers and hardware manufacturers. Step 3. Now draw a larger circle around the first one. This is your circle of reasonable familiarity. These are areas where you have a strong interest and have done significant learning but are not a true expert. Maybe you've read 10 books on the railroad industry, or you follow the cloud computing sector closely. You can list these here, but with a note of caution. Step 4. Everything else in the entire universe of business and finance exists outside that second circle. This is your too hard pile. It includes 99% of all public companies. It is the zone of your acknowledged ignorance. The final and most important step is to create a written constitution for your investing. Rule number 1. All of your investment capital must be deployed into ideas generated from inside the inner circle. Rule number 2. Ideas from the outer circle can be researched for educational purposes, but cannot be invested in until they have been studied so intensely that they can be moved into the inner circle. Rule number 3. When you hear a stock tip from a friend, a TV pundit, or a social media influencer, your first action is to see where it falls on your map. If it's outside the circles, you are forbidden from even researching it further. This simple map is your defense against yourself. It enforces the discipline required for long-term investing success and ensures that your capital is only ever put to work where you have the highest probability of avoiding a catastrophic, ignorance-based mistake. The antithesis of this focused, disciplined approach is the all-too-common strategy of diversification. This term, famously coined by the legendary fund manager Peter Lynch, describes the process of adding more and more investments to a portfolio to the point where the benefits of diversification are outweighed by the costs of ignorance. The common financial advice is to diversify your portfolio, which is often misinterpreted as own a little bit of everything. Investors end up with a portfolio of 50 or 100 different stocks, spanning dozens of industries, from biotech to banking to mining. The problem is that they have no genuine understanding of the vast majority of these businesses. They have diversified their holdings, but they have concentrated their ignorance. They can't possibly keep up with the quarterly earnings reports, competitive shifts, and management changes for all of these companies. They are relying on a false sense of security, believing that owning many things is inherently safer than owning a few. But as Buffett has often said, wide diversification is only required when investors do not understand what they are doing. For the investor who operates strictly within their circle of competence, a portfolio of just 5 to 10 wonderfully understood businesses bought with a significant margin of safety is far firster risky than a 100-stock portfolio of poorly understood companies. The diversified investor is exposed to risks they can't even see. The focused expert investor has eliminated the single greatest risk, that of not knowing what you own. They have traded the illusion of safety from owning everything for the genuine security that comes from truly understanding a few things. This is the path of the professional, a rejection of the index-hugging consensus in favor of a concentrated, knowledge-based portfolio strategy. The direct financial connection of this pillar is the creation of a sustainable information edge. In the world of investing, you don't get paid for effort. You get paid for being right. The stock market is one of the most competitive arenas on earth. On the other side of your trade is a legion of highly intelligent, well-paid Wall Street professionals who have access to immense resources. Trying to beat them at their own game across the entire spectrum of the market is a losing proposition. However, when you operate strictly within your tiny circle of competence, you can actually turn the tables. If you have been a software engineer for 20 years, your understanding of a specific enterprise software company's product and competitive position is likely far deeper and more nuanced than that of a 25-year-old analyst who covers 30 different tech companies. You can spot inflection points, competitive threats, and product quality issues long before they show up in the financial statements. This is a real, tangible, and perfectly legal information advantage. It allows you to perform a level of due diligence that is simply impossible for the generalist. This edge translates directly into superior investment selection. You are more likely to identify the true long-term winners and, just as importantly, to avoid the plausible-sounding companies that are destined to fail. This leads to a portfolio with a higher batting average, fewer strikeouts, and better long-term returns. Your deep knowledge also gives you the conviction to hold on during periods of market volatility, and even to buy more when others are panicking. By staying within your circle, you are not just managing risk, you are creating a powerful offensive weapon. You are ensuring that you are always the smartest person at the table for the very specific game you have chosen to play, a direct path to superior long-term financial freedom. We have now assembled a formidable defensive system. We understand the brutal asymmetry of loss. We have anchored ourselves in the reality of intrinsic value. We have built a cushion against error with a margin of safety, and we have sworn to stay within the bounds of our own competence. But there is one final pillar, a capstone that holds the entire structure together. It is perhaps the most difficult of all, because it is not an analytical skill, but a temperamental one. This is the fifth pillar, the power of patience and inactivity. In a world that screams for action, that celebrates speed and glorifies trading, Buffett's greatest competitive advantage may be his ability to do nothing. His investment philosophy is predicated on the belief that truly great opportunities are rare. They do not come along every day, every week, or even every year. Therefore, the majority of the time, the correct course of action is to sit patiently, with cash in hand, and wait. This is the polar opposite of how the investment industry is structured. Wall Street and the financial media have an institutional bias for action. They need you to trade, to switch funds, to react to every headline. This generates commissions, fees, and clicks. But for the individual investor, this constant activity is a wealth-destroying disease. Buffett compares investing to being a baseball batter where the pitcher is the market. The great news is that in this game, there are no called strikes. You can stand at the plate all day and watch thousands of pitches go by, overvalued pitches, pitches outside your circle of competence, pitches with no margin of safety, and you are not penalized. You can wait and wait and wait for that one perfect, slow, fat pitch right down the middle of the plate, and only then do you swing with all your might. This ability to wait for the fat pitch is a superpower. It requires immense patience and a complete disregard for the opinions of the crowd, who will inevitably tell you that you're foolish for not swinging at everything. One of the greatest demonstrations of this principle was Buffett's investment in the Washington Post Company in 1973. At the time, the stock market was in a deep funk. The Nifty 50 bubble had just burst, and pessimism was rampant. The Washington Post, despite being a dominant media franchise with an unassailable competitive moat in its market, saw its stock get hammered along with everything else. The company's total market capitalization fell to around $80 million. Buffett, who had a background in the newspaper business and understood it intimately, it was deep inside his circle of competence, did the work. He realized that a conservative valuation of the company's assets and brand was at least $400 million and possibly as high as $500 million. The market was offering him a $500 million business for $80 million. It was the ultimate fat pitch. He began buying shares aggressively, investing over $10 million, which was a huge sum for Berkshire Hathaway at the time. And then, after he had acquired his stake, he did the most important thing of all: absolutely nothing. He didn't try to time the market. He didn't try to tell the company's brilliant management, led by Katharine Graham, how to run their business. He simply held. He held through the stagflation of the 1970s. He held through the crash of 1987. He held through recessions and booms. He held for over 30 years. That initial $10 million investment, left to compound patiently in a wonderful business run by able and honest people, grew to be worth over $1 billion. This story is powerful not just for the brilliant initial analysis, but for the decades of masterly inactivity that followed. Another example is his willingness to hold cash. There have been long periods, sometimes lasting for years, where Buffett found nothing that met his strict criteria of competence, value, and safety. In the late 90s during the tech bubble, or in the years leading up to the 2008 crisis, Berkshire's cash pile grew to tens of billions of dollars. Pundits called him foolish for holding so much low-yielding cash, but he was simply waiting. He was refusing to swing at bad pitches. And when the crises inevitably arrived, and the market was filled with panic and forced sellers, he was ready with his cash bat to swing at the incredible opportunities that presented themselves, buying stakes in Goldman Sachs and Bank of America on terms that were almost unbelievably favorable. Patience is not passive. It is a strategic weapon. The psychological demon that this pillar is designed to slay is called the action bias. This is our innate evolutionary drive to favor action over inaction, even when inaction is the more logical course. Our ancestors on the savannah who saw a rustle in the grass and immediately ran away were more likely to survive than those who sat and patiently analyzed the situation. In the modern world, and especially in investing, this instinct is a catastrophic liability. The feeling of "I have to do something" is powerful. When the market is volatile, our action bias screams at us to sell, or to buy, or to rebalance, anything, to give us the illusion of control. The entire fintertainment industry is built to exploit this bias. Financial news channels with their breaking news alerts, their countdown clocks, and their panels of shouting experts are designed to create a sense of urgency and emergency. They need you to believe that you must act times now dives based on this latest piece of information. Trading apps that use gamification, sending you push notifications and showering your screen with digital confetti when you make a trade, are engineered to give you a dopamine hit for activity. They are turning investing into a video game. Buffett's philosophy of inactivity is a radical rebellion against this entire ecosystem. It is the deep, Zen-like understanding that your portfolio is like a bar of soap. The more you handle it, the smaller it gets. Great long-term investing is supposed to be boring. It should feel like watching paint dry. The discipline to sit still, to let your well-chosen businesses do their work, to ignore the constant noise and temptation to act, is perhaps the rarest and most valuable skill in all of finance. It requires a level of emotional control and long-term perspective that is almost inhuman, which is precisely why it is so profitable. To cultivate this superpower, we can use a mental model that Buffett himself has advocated for, the 20-slot punch card. He tells young investors to imagine that when they are born, they are given a punch card with only 20 slots on it. These 20 punches represent every investment decision they are allowed to make in their entire lifetime. Once you've made 20 investments, you can't make any more. Think about how that would change your behavior. You would become incredibly selective. You wouldn't waste a single precious punch on a half-baked idea or a speculative whim. You would only swing at the most obvious no-brainer opportunities. You would do exhaustive research, ensuring that every condition was perfect before you committed. And once you made an investment, you would intend to hold it for a very, very long time, because selling it would not get you your punch back. The 20-slot punch card is a mental model designed to force a mindset of extreme selectivity, concentration, and long-term thinking. It completely short-circuits the action bias. You can put this into practice today. Create a physical or digital representation of this punch card. Before you make any new investment, ask yourself, is this idea so good, so safe, so obvious, that I am willing to use one of my 20 lifetime slots on it? This question raises the bar for decision-making to an incredibly high level. It stops you from the casual, low-conviction trades that so often lead to mediocre results and high costs. It forces you to think like a true business owner, not a hyperactive trader. It transforms your portfolio strategy from one of broad, ignorant diversification to one of focused, deep conviction ownership. It is the ultimate tool for enforcing patience and ensuring that when you do finally act, you do so with maximum force and maximum probability of success. The antithesis of this patient, selective approach is the entire complex of high-frequency trading and financial entertainment. This is the world inhabited by the 99%. It is a world that runs on speed, volume, and constant stimulation. The high-frequency trader believes that by using complex algorithms and light-speed connections, they can gain a microscopic edge by trading in and out of stocks thousands of times a second. The day trader believes that by staring at charts all day, they can discern patterns that will predict the next few minutes or hours of price movement. The average investor, bombarded by cable news and social media, believes that they need to have an opinion on the latest inflation report or geopolitical event and adjust their portfolio accordingly. This entire ecosystem is a giant wealth transfer machine. It transfers wealth from the impatient to the patient. It does so through commissions and fees generated by high trading volume. It does so through the bid-ask spreads that market makers collect. But most insidiously, it does so by encouraging emotionally driven, ill-timed decisions. The person who sells in a panic because of a scary headline is selling to a patient investor like Buffett, who has been waiting for just such an opportunity. The person who buys into a mania at its peak is buying from a patient investor who is happy to sell them an overvalued asset. The entire system is designed to prey on your action bias, your fear, and your greed. It is a siren song luring you onto the rocks of high turnover and bad decisions. The path of the 99% is to be constantly plugged into this machine, to feel the need to react to every piece of news, to believe that activity equals progress. The path of the patient investor is to unplug from the machine entirely, to embrace boredom, and to understand that in investing your greatest profits are often made not by what you do, but by what you don't do. The direct financial connection of this pillar is arguably the most powerful and least appreciated source of long-term returns: the minimization of frictional costs and the maximization of tax efficiency. These are the invisible termites that silently eat away at a portfolio's foundation. Every time you trade, you incur costs. There are explicit costs, like commissions, and implicit costs, like the bid-ask spread. While these may seem small on a per-trade basis, over a lifetime of hyperactive trading, they add up to a staggering sum that is siphoned directly from your pocket into the pocket of the financial industry. But the far greater cost is taxes. Every time you sell a winning investment that you've held for more than a year, you are required to pay long-term capital gains tax on the profit. Let's say you invest $10,000 and it doubles to $20,000. If you sell, you have a $10,000 gain. At a 20% capital gains rate, you owe $2,000 to the government. That $2,000 is now permanently removed from your compounding engine. It is gone forever. Your new base for compounding is only $18,000. Now consider the patient, inactive investor. They buy the same $10,000 investment. It also doubles to $20,000. But they don't sell. They hold. The entire $20,000 remains in their account, working for them. The $2,000 in deferred taxes is like an interest-free loan from the government, and the earnings on that loan accrue to the investor. When you extend this out over a 30 or 40-year investing career, the difference is astronomical. A low-turnover, long-term portfolio strategy allows your entire sum of capital to compound, uninterrupted, for decades. This is a core principle of sophisticated wealth management. The tax efficiency alone, created by simple inactivity, can be the difference between a comfortable retirement and true financial freedom. It is the quiet, mathematical proof that in the game of wealth building, the tortoise who sits still will always beat the hyperactive hare. It is the final powerful reinforcement of rule number 1. The surest way to not lose money is to avoid the guaranteed losses of taxes and fees that come from endless pointless activity. You have just been given the blueprint to a fortress. We have deconstructed the most powerful rule in finance, not as a clever phrase, but as a complete system of thought. You now understand the brutal, unforgiving mathematics of loss, and why protecting your capital is not a defensive move but the most powerful offense for long-term growth. You have learned how to build your own anchor in a sea of chaos by calculating the intrinsic value of a business, separating its reality from the market's fleeting opinion. You have been given the practical tool of the margin of safety, the engineered cushion that protects you from a world that is inherently unpredictable and from your own inevitable mistakes. You have mapped your circle of competence, the ultimate defense against the most dangerous risk of all, your own ignorance. And you have embraced the profound, difficult power of patience, the temperamental superpower that allows you to avoid the wealth-destroying noise of the market and wait for the opportunities that truly matter. You no longer see investing as a casino, a place of luck and frantic guesswork. You see it as a discipline of risk elimination. You have acquired the mindset that is the bedrock of all great fortunes and the source of all true financial security. But this entire system, this magnificent fortress of capital preservation we have just built, is only one half of the equation. It is the shield, the impenetrable defense that guarantees you will stay in the game. But what about the sword? What are the specific, identifiable characteristics that Warren Buffett looks for when he finally decides it is time to swing, to deploy the capital you have so carefully protected? What is it that transforms a merely safe investment into a true, multi-generational compounding machine? The principles of avoiding loss are what get you to the starting line and keep you in the race. But the principles of identifying truly extraordinary businesses are what allow you to win the race in a spectacular fashion. The video that is now appearing on your screen is the next piece of this map. It is the crucial link that connects the strategy of not losing money with the art of compounding money at an extraordinary rate. You have taken the first and most critical step by learning to build an unbreachable foundation. The choice you now face is a simple one. Are you content to sit inside your fortress, safe and secure? Or are you ready to learn how to install the engine inside of it? The engine of quality, growth, and management that will power your financial journey for a lifetime? The path to becoming a complete investor, a true owner of businesses, continues with the single click you are about to make.